nothing fundamental really has changed since the beginning of 2024. We're still operating on the leftover printing from 2020. We're almost out now, finally. But we're still operating on that. So it's the same basic monetary structure. So, based on that, it just seems like there's a good chance here that the consolidation in gold is pretty much over. And once we pass 3,500, we should start seeing the next rally, which shouldn't take too long in time span. It should be about 1 or 2 months until we get to a new plateau. Could be 4,000, could be higher than that. It's hard to tell exactly where it'll stop.
The Federal Reserve's fiscal year 2025 budget sets aside $42.5 million for currency production, covering 67% of the total $64 million requirement. The annual print order has jumped from 5.56 billion notes in 2024 to 6.8 billion in 2025, a 22% increase that points to rising strain within the financial system. Rafi Farber, author of The Endgame Investor, sees this as a symptom of a deeper problem. Financial crises are escalating, and central banks are responding with increasing urgency. Bigger print orders are just the visible part of a system that's increasingly stretched. Since the U.S. abandoned the gold standard, the dollar has lost over 90% of its purchasing power. A dollar from 1970 now takes more than $7 to match in value. Inflation-targeting mandates haven't stopped the steady erosion. Each round of monetary expansion tends to plant the seeds for the next, creating a loop of damage and response that demands more printing. Now, physical note production is surging even as digital monetary infrastructure continues to grow. This dual expansion makes forecasting nearly impossible using traditional models. Policymakers are reaching deeper into their toolkit, but each intervention seems to require another. Farber argues that the monetary backdrop has remained essentially unchanged since 2020. Markets are still riding the aftershocks of massive stimulus programs that are now largely exhausted. As that liquidity dries up, he expects gold's consolidation phase to break decisively. His call is clear. A move above $3,500 could spark a rapid rally lasting 1 to 2 months, with prices potentially reaching $4,000 or higher. That view isn't fringe. Major Wall Street players, including Goldman Sachs and JP Morgan, are calling for a $4,000 gold price by mid-2026. That would mark a significant move, especially considering gold first closed above $2,000 in April 2023 and surged past $3,000 in March. Farber also sees strong potential in silver, expecting it to outperform as the next cycle of monetary expansion kicks in. While short-term corrections remain possible, the long-term case for precious metals is strengthening. The mix of unsustainable debt levels, fading stimulus, and relentless currency debasement is creating a setup where gold and silver may not just hold value, but aggressively reprice. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Since 2024, I think, the beginning of 2024, we've had a few consolidations in gold. There are many different ways to count a consolidation. You can debate where you want to start counting, where you want to stop counting. But if we just take just a general idea of what a consolidation is, the price doesn't go beyond a previous high, then the average length of a consolidation since 2024 has been about 4 months. There's been one that was 3 months. And usually the rallies are between 1 and 2 months. So the rallies are shorter in time span than the consolidations. That's how it's been. Doesn't mean that's how it always will be, or that's how it necessarily will be this time. But nothing fundamental really has changed since the beginning of 2024. We're still operating on the leftover printing from 2020. We're almost out now, finally. But we're still operating on that. So it's the same basic monetary structure. So, based on that, it just seems like there's a good chance here that the consolidation in gold is pretty much over. And once we pass 3,500, we should start seeing the next rally, which shouldn't take too long in time span. It should be about 1 or 2 months until we get to a new plateau. Could be 4,000, could be higher than that. It's hard to tell exactly where it'll stop. But in the meantime, we also have to look out for the end of the last tranche of 2020-2021 printing, money printed fuel. And because we have now still about $100 billion left in reverse repos, which is the backup money supply that comes in every so often, that's still going to run out. And when it does, the Fed is going to have to print again because all of the extra reserves are still being used in the plumbing of the system, and they can't be double booked. They can only go in one direction. And all of the hedge funds and everything like that that uses that money, they need that to keep coming or they have to close their trades, and that could cause a systemic toppling. So before that runs out, we should see gold start to rally, and I'm not discounting that gold and silver will get hit, perhaps severely, though less severely than most other things, in the event of some kind of a clog in the plumbing. But that's only going to be like, a few days until the Fed responds, and then we should see a slingshot. So I'm not counting that as part of the trendy consolidation versus rally. That's something else. Like, for example, if you look at 2020, like February, March, April 2020 in gold, it was a humongous dip, and it was one of the worst dips in history for gold stocks. But if you look on a chart that's 5 years or longer, you don't even see it. It's not even there because it was so short. This one's going to be even shorter. It's going to be very scary, but it's going to be shorter. In terms of percentage, I think gold was like 25% from the top, maybe in February 2020 or early March 2020 to wherever it stopped at 1450. I think it was like maybe 1800 down to 1450. What percentage is that? It's something like 20-25% and I don't think I'm wildly off there. I'm just not doing the math in my head. So, we could see something like that. What's 25% of, let's say, 3,600, about $700 down. So could I see a crash in gold to like maybe 2,800, 2,900 and real panic on a repo crunch? Yeah, it's possible. But most of my positions were established way before 2,800. So, unlike 2020, which really got me, my heart pumping in a bad way and, sweating, I held on. But this one, it would be like, a little bit, like a mild roller coaster, like something I could handle. And I'm sure most of your followers could handle it too if they got in before 2,800. So it'll be difficult, but it won't be a 25% dip from here wouldn't affect most of the stackers as, a 25% did from 1,800 to 1,450. So it could be a similar breadth or a similar move percentage wise, but I don't think the stackers are going to be fooled like they were last time. As you go down the fiat process, crashes get closer and tend to get more intense. But the intensity also, on the one side, yes, they do get more intense. On the other side, the Fed becomes more aware that it's going to have to act sooner and sooner following any kind of sign of stress, which is what we saw in 2019 and in 2020. And I think we're going to see it again. So we're going to see some kind of intense move. But we're also going to see the Fed act very quickly, where in 2008, it took them, maybe, a few months. It depends where you count where the stress started. You could count it years, starting with the top in the real estate market in 2006. You could start it with the excess reserves or whatever they were doing in the banking system in 2007, where they allowed the Fed to pay interest on excess reserves. See, most people don't know that entire process, that entire set of rules was only instituted once the banks told Congress, look, we need the Fed to be able to pay interest on excess reserves to keep all these reserves out of the monetary system because otherwise everything's going to explode. That actually happened before the financial crisis even happened. So you count it in many different ways, but however you count it, it took the Fed some appreciable amount of time to really get moving, right? In 2019, it was much less. It was like they saw repo going up and up for maybe a week or two before they moved, and then they only moved when it really spiked. And in 2020, they acted immediately. The Congress or whoever was in charge of locking down the planet said, look, we're going to do this. And the Fed says, okay, we'll print $4 trillion like in the next day. So it's going to be very quick, but it's going to be very extreme. In terms of will it be felt in the stock market, I don't think for beyond a day or two in terms of nominal values, but once the printing starts this time, I think we're going to see gold and silver, especially silver, really start to move like in ways that are going to be scary even for stackers. Because if you put yourself in our situation, in order for silver to, let's say, move like 20-30% a day, right? When that happens, we're going to see some really scary stuff happen in the equity markets, happen in the bond markets. Prices, oil is going to start heading up. Commodities are going to start heading up, not as fast as gold and silver, but they're going to start heading up very scary. And we're going to feel like, happy, but, worried at the same time. That's when we know that we're really close. When our happiness is tempered by our own fear, even if we're in a good situation financially, which is Once you start feeling that, you'll know we're almost there. And I think that's going to start to be felt once the next printing round begins, whenever the last bits of monetary stimulus from 2020 finally run out. Should be in a few weeks now.
The financial system is leaning into dangerous territory as margin debt blows past the $1 trillion mark, a level that's more than just a psychological milestone. Rafi Farber draws attention not just to the size of the debt, but to the speed at which it's accelerating, something that carries far more weight when assessing market fragility. According to FINRA's latest data through June, total margin debt now stands at $1.007 trillion, a second consecutive monthly rise. What stands out is the scale, a 9.5% spike from May, the sharpest one-month increase since November 2020. On a year-over-year basis, margin debt has surged 24.5%, reflecting the kind of momentum that rarely ends well. Farber flags the explosive pace of certain recent months, where growth exceeded 15%, some of the fastest on record. That kind of leverage buildup usually means one of two things. Either investors are all in with extreme confidence, or the market is caught in a wave of speculative mania. In either case, the risks are stacking. Even after adjusting for inflation, the story doesn't soften. The monthly growth still clocks in at 9.1%, the highest since December 2021. Year over year, real margin debt is up 21.3%, far outpacing general price increases. This isn't just nominal bloat from a weakening dollar, it's real leverage expansion. What all these points to is an environment where risk is being repriced with alarming speed. Markets are borrowing more to chase returns, and the cost of getting it wrong is rising with every uptick in that debt curve. If sentiment flips, or liquidity tightens, this level of leverage could turn a correction into something far more violent. Let's get back to the interview.
I queried some AI on this just to make sure I'm right. I don't use them for my primary research, but I check my conclusions with AI to see if there's something wrong with them. So this checked out, at least. So if you imagine what's happening in a margin trade, when let's say an institutional trader wants to increase his position for his clients, so he borrows on margin from the broker. The broker's got to get the dollars from somewhere. The broker gets it from the bank. The bank gets it from the repo market, at least, about half the time. So what happens is ultimately you have this loan that's secured by equities by the client to the broker, right? The broker pledges his securities, which he still owns, but the broker maintains his right to sell those securities by force if the margin loan can't be paid in time. So that puts the client of the broker in danger of having his stocks force sold. And the broker itself has to pledge those securities to the bank, right? The same securities that the client pledged him, ultimately they're pledged to the bank. So the bank has to sell, it's really not up to the broker. The broker is just a middleman. The bank has to sell the securities so it doesn't get its dollars back. But where does the bank get its dollars? It gets its dollars from the repo market, for which the bank that's giving dollars ultimately lends the repo market every night treasury securities. So these margin positions are ultimately dependent on the treasury securities that are pawned off to the repo market to another bank to secure the dollars that some other bank has in reserve. So since people are always asking for more and more margin, as we see, I think Andy Schefman talked about this you interviewed him recently, and he was talking about how margin loans have exceeded $1 trillion. There's no significance of $1 trillion other than that we're base 10 humans because we have 10 fingers and 10 toes. So 1 trillion is a psychological number for us. But what's more significant is that the rate of increase in margin, the amount of margin debt outstanding that's ultimately secured by treasury securities, right? That the rate of that has been going up and up. The acceleration has been going higher and higher, and we've had 2 months of, I think, above 15% monthly acceleration, which we only had, I think, once in 2000 or 2 months consecutive 15% or higher, something like that. I know it's in the double digits, and it's among the highest months of acceleration in margin debt ever. So what happens is if the dollars run out in the repo market, right? And then the amount of interest that you have to pay, because it's supply and demand. If there's more demand for the dollars than there's dollars available, the interest on those dollars has to rise. And that means that ultimately the client that's taking the margin, right, he has to pay higher interest rates. If he can't pay them, right, in order to pay them, you have to because he has no cash in his account. Otherwise, he would be trading on margin. He's already fully positioned, so he can't pay those suddenly spiking interest rates. And then they have the broker gets called in by the bank, like, you have to pay me that interest because we're having a repo clog here, and the interest is going up on those daily, nightly repo loans. So you have to sell those positions and pay that interest. And then the bank said, but if everyone's doing that, everyone has to sell the positions. The value of the stocks that they bought on this margin loan are going to go down together because everyone has to sell it, pay the interest rates. Right? And then if the value goes down enough, then if it goes down enough, then they can't pay back the margin loan itself, the principal. If the value of the stocks being pawned off for the margin rate for the margin loan in the first place can't be pawned off, and then the bank itself gets in trouble because the bank is the one that pawned off the treasuries in order to get the cash in the first place to give to the broker to give to the client. So if the bank's treasuries get forced sold, so the bank has to sell those securities plus some of its securities that they secured with the other bank to get the dollars, then you have a whole bunch of treasuries being forced sold at the market in order to pay back these margin loans. So what you have is eventually, if it's allowed to go on long enough, let's say a few days or a week or two, which I don't think it's going to last that long because the Fed's not going to allow it, then you have the situation of stock positions being forced sold to pay back repo margin loans. And if the value is not enough because everyone's selling, then a lot of treasuries get sold in order to cover the repo loans where the stock values can't plug in the hole. So you have rising interest rates, short-term interest rates on the repo market, plus rising long-term interest rates if treasuries are being repossessed in order to pay back these repo loans, and everything's falling at the same time, which would include gold and silver and everything except the US dollar itself very temporarily until the Fed steps in, which is what it's going to have to do. Everything the Fed does is by definition a bailout because they create claims on gold that doesn't exist and give it to people so that they can spend. Whatever the Fed does is a bailout. It just comes in bigger or smaller chunks. So basically a bank can do whatever it wants, and it might experience some minor consequence somewhere. You have a headline, Wells Fargo paid $2 billion in fines for spoofing or whatever it is. And then, the article goes into what spoofing is and why it's immoral. But then again, the entire banking system is being bailed out every day by the Fed providing whatever it is on the back end. It's just that we see it more in chunks when it happens in a bigger way, like we saw in 2008, like we saw in 2019, like we saw in 2020. Like, they could shut down the entire planet without consequence. Not without consequence. There will be consequences, but you can delay them with inflation, or you can spread them out over a longer period of time with inflation so they're less noticeable, right? If there was no Fed and there were lockdowns, people would starve within days. And that didn't happen because of the money that was printed that could just flow through the system and keep it sort of kind of working so that nobody starved to death. But yeah, so if we're going to take the example of executive function with children, the bankers today, they don't even know that what they're doing is, most of them don't know that what they're doing is wrong morally. They don't know what money even is anymore. They're proud of how they are handling the current pyramidal structure, which if you listen to the details of it and listen to them explain, some of them are very smart people, and most of them they're not nefarious people individually. They're not trying to hurt anybody. They're just doing what they see as the system and they're trying to keep it in balance. So that's what they're supposed to do, but they don't know that it's wrong. Just like kids don't have an executive function because they were never taught what following directions is. Bankers don't know what they're doing because they've never been taught what money is. It's the same thing. It's just one is the entire society, the entire economic structure, and the other is one child who was never taught by his parents to listen to what they say. A lot of people on the margins are going to lose their jobs. I'm in the U.S. now, and I'm seeing really concentrated trends in certain industries that are kind of scary. I mean, if you think about them, like every billboard that I see is, some kind of, not every single one, but like, so let's say, 50-60% of all billboards as I drive on the highways, they're about, there's this big amount of money, let's say $500,000, and some injury attorney, you're talking about how he can sue for you. I hear these ads on the radio nonstop about the same thing. Everything's concentrated now. All the money's concentrated in insurance claims and accidents and injury claims and whatever. All this is where all the big inflation is going, or part of it. So when you have a society that's so concentrated in these very specific areas that are not very productive, all of that money goes away, and you have all these people in these very inflated industries that are suddenly unemployed and they have nowhere to go because there's no demand for their services anymore. Right. So the people that are in the very concentrated inflation influenced areas like litigation, that's one of the reasons we have such a litigious society.
Fresh evidence keeps piling up that something's breaking beneath the surface. Soaring margin debt, exploding currency print orders, and stubborn inflation are no longer isolated signals. They're part of a broader pattern. The feedback loop between stimulus, speculation, and systemic risk is tightening. Monetary authorities appear trapped in a cycle of overreaction, where each policy fix leads to a new imbalance. Meanwhile, traditional metrics used to gauge stability are being outpaced by the rapid pace of change. What's emerging isn't just volatility, it's structural exhaustion. In a system this stretched, how much longer can markets absorb shock after shock before trust in the whole framework gives way? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.